Assume a company tax rate of 28% and dividend withholding tax of 20%. Laserjet is a company that was incorporated in 2000 with the following authorized shares: 1,010,000 Rand par value ordinary shares, 400,000 par value cumulative 10% compulsory redeemable preference shares of 11 Rand each, and 150,000 5 Rand par value 12% convertible preference shares. Par value, par value, par value. That means that there was a nominal value attached to a share. The ordinary shares had a nominal value of 10 Rand. So I could have issued shares at a higher value than 10 Rand, but the amount more than 10 Rand, let's assume we have issued it at 12 Rand a share. That additional 2 Rand a share we would have had to account for under the share premium account. And the same thing apply here. This par value was 11 Rand each. This par value was 5 Rand each. Now, the New Companies Act says that we are not allowed to issue par value shares anymore. Although, if a company has issued par value shares somewhere in the past, then they do not have to do anything. They can continue as is. They will have a share capital account and a share premium account. It says, but whenever you want to issue new shares of that same class of shares, let's say, for example, here they had an issue 600,000 10 Rand par value shares, and it was issued at 10 Rand 50 a share. So if they want to issue further shares, then they first have to convert this par value share into a no par value share, and then they can go around and issue more shares. Okay. What do we have to do before we start with anything? They want you to do explain why the convertible preference shares first need to be converted to no par value shares before any share issue of this class may be done. Now, that is according to the Companies Act of 2008, which explicitly states that when you have par value shares in issue and you wish to issue more shares of that same class, you first have to convert the existing shares which were issued to no par value shares. And then we have to do the prepared statement of changes in equity for the year ended 28 February 23. It is not necessary to complete the total column and provide a journal entry for the declaration of the ordinary dividend. Okay, so let's then start. We've already done A, so B starts with the statement of changes in equity. So for every equity type of item, you're going to open up our own column. The first one would be your ordinary shares. Now, it was par value shares. Par value shares was issued at a premium of 50 cents a share because there's a nominal value of 10 Rand attached to that. So my opening balance, I would have had balance at the beginning of the year, 600,000 times 10 gives me 6 million Rand in the share capital account and 300,000 Rand in the share premium account. So let me show you that. Where is it? Yeah. Laserjet Limited, statement of changes in equity for the year ended 28 February 2013. Ordinary shares. Opening balance, 6 million in the ordinary share capital account, 300,000, i.e. 600,000 shares multiplied by 50 cents, 300,000 in the share premium account. Then we had 150,000 par value 10% cumulative compulsory redeemable shares at 11 Rand per share. What did we tell each other about cumulative compulsory redeemable pref shares? It's not an equity item, and should you show it in the equity as part of your statement of changes in equity, minus 5 marks. Minus 5 marks on the spot. Before you start to do any other mistakes, minus 5. Gone, weg, choo, boom. So, 150,000, what was the par value? The par value was 11 Rand each, and it was also issued at 11 Rand each. Now, I want to tell you something about that as well. So here, that was the compulsory redeemable preference share. So it's not going to be in my statement of changes in equity. You see that there's no way a column for that. So I'm going to go on the sideline and I'm going to have a T account, 10% redeemable pref shares. And that would have had an opening balance of 150,000 of 11 Rand 1650. On the side, I have to show it somewhere, but in a T account on the side so that I can refer back to that and do something with that if I need to do something with that. Good. Then I had 5 Rand par value 12% convertible pref shares. So they were authorized to issue 150,000. Up till now, they haven't issued anything. The directors of the company decided on 30 June 22 to issue a further 150,000 ordinary shares at an issue price of 12.50 Rand per share, after the existing ordinary shares were converted into par value shares. Now let's stop the boat there for a moment. We had par value shares. We had a 6 million and a 300,000. Now they say they want to issue more of this class of shares. We want to issue more ordinary shares. So before we can do that, we first have to convert the existing par value shares into no par value shares. Guys, and the process is extremely easy. All we go and do then is we take the 6 million, the par value of those ordinary shares, out of that account, ordinary share capital account. And we transfer that to a so-called ordinary share declared capital account. The same thing we're going to do with the share premium. We're going to debit the share premium account and we're going to credit the ordinary share capital declared capital account. So all we do is we transfer these two balances into one new account and we call it declared capital. So whenever you see the words declared capital, or another word that they like to use is stated capital. Whenever you see stated capital, it means it's no par value shares and you can go along and can issue more of that class if you have authorized shares that you can issue. So you take it out, you transfer that to that account. Very easy peasy. Then they decided that they're going to issue a further 150,000 shares at 12.50 Rand a share. It was decided to make use of the services of an underwriter at a commission of 3%. It is the policy of the company to maximize retained earnings as far as possible. What on heaven earth does that mean? That means we do not want to write off unnecessary stuff against retained earnings. So by implication, what they tell us there is all share issue costs and underwriter's commission should be written off against the capital that was issued. Right. By 15 July, the public applied for 100,000 shares, and on the same date, the shares were allotted. How many shares did they want to issue? They wanted to issue 150,000 shares. So what did I tell you? Whenever there's a share issue, what is the first question that you have to ask yourself? Was there an underwriter? If the answer is yes, it means that the underwriter, should there be any shortfall in applications received by the company, the underwriter will take up the shortfall. So although the public only applied for 100,000 shares, the underwriter would have taken up the additional 50,000 shares. So out of an accounting perspective, how many shares were issued? 150,000 shares. At what price? At a price of 12.50 Rand per share. So in your statement of changes in equity, you would have had under ordinary share capital, declared capital account, 150,000 shares at 12.50 Rand. The underwriter's commission amounted to 3% of the total issue value of the shares. Now, the total issue value of the shares was also 150,000 times 12.5%, and it is the policy not to write it off against retained earnings. So what I'm going to do is say, well, the total value of shares issued or that they wanted to raise with a share issue was 1,875,000. Multiplied by 3% will give us a total underwriter's commission of 56,250. I debit underwriter's commission. I credit bank 56,250. I credit underwriter's commission. I debit ordinary share capital declared capital account 56,250. Therefore, I have to reduce my ordinary declared capital with the amount of commission. I do not do that automatically. I do not net it off against the 1875. I have to show two line items. One for what did I raise, and the second one, how much should I pay out as share issue costs and underwriter's commission. Great. On 30 August 22, it was decided to redeem 50% of the redeemable preference shares at R11.20 per share. No shares were issued to finance the redemption. In other words, that means they had enough money in order to do that themselves. At what price was the redeemable shares issued? Well, we issued it initially 150,000 at R11 per share. But we are going to give this shareholder a sweetener back. Now remember, this is not share capital. This is not equity capital. This is loan finance. So how much money are we going to give them back? Well, we've issued initially 150,000 shares and we're going to give them 20 cents per share back multiplied by 50%. We're not going to redeem all of that. We're only going to redeem 50% of that. And that then, 20 cents times 50%, and that equals 75,000 Rand. Now, the first thing that you must ask yourself is how much money is currently lying in the share capital account. Remember when we started off, we did the account. We said, well, there was 150,000 at R11, which is 1650. We're going to repay 50% of that amount. Can we take out of this account 75,000 shares at R11.20? No, we can't, because initially we only posted R11 per share. So if we're going to redeem 50%, it will only be 50% of that amount, which equals 825,000. So it was 150,000 shares, 50% being 75,000 shares. 75,000 shares multiplied by R11.20 a share equals 840,000. How much could we take out of there? We could have taken out there 825,000. So the premium there equals 15%. I think I put it down here totally wrong. 15,000 Rand. So if you check there, 150,000 shares, initially 20 cents a share, that is the premium, and it's going to be 50%. So 15,000 Rand, the share premium. Now, if we go back to the capital, the share capital account, what is going to be then our, let's put it in here, our general journal entry. What are we going to debit? We're going to debit the redeemable capital account with how much? The amount of 825,000 Rand. Then we're going to have a premium on the redemption of 15,000 Rand. And how much are we going to pay them out at the end of the day? Bank. 840,000 Rand. I'll just make it a bit bigger. So then we've worked it out. 75,000 shares is 50% times R11.20 equals 840,000. So there you can see 840,000 Rand. Now that premium account is lying in our books now at a debit. Come year end, I have to do something with that, because that can either be an asset, which it is definitely not. I've paid a premium. There's no future use out of that. So, or an expense. Is it an expense? Is it a normal operating expense? No, it isn't. It's got everything to do with finance, and we can apply that premium only against retained earnings. So I come year end, we're going to debit retained earnings and we're going to credit the premium account. So what is the impact of this on the statement of changes in equity? Retained earnings, a debit against retained earnings, is going to reduce our total retained earnings. So it's going to be a line item here. Premium on the redemption of shares, 15,000 Rand. There under retained earnings. Seeing that by the time of the commencement of the New Companies Act, no 5 Rand par value 12% convertible pref shares is that last batch there. We are authorized to issue 150,000, but up to the beginning of the year, there was nothing issued. And the company would now like to issue the share of this class this year, but these shares, we know, first have to be converted into no par value shares. Is there something in our books? No. Are we going to do something out of an accounting perspective? No. What is going to happen? Well, the shareholders have to make a special resolution. The memorandum of incorporation needs to change, and CIPC needs to be informed about the decision as well as the change in the MOI. So therefore, at the end of the day, it means it is purely behind the accounting scenes that a lot of things are going to happen. But for accounting purposes, we're not going to do anything because there is nothing in the books as yet. After the conversion was completed by the directors, 50,000 12% convertible shares was issued at 3 Rand per share. So total 150,000. The share cost amounted to 1,000. The issue cost, in other words, was 1,500 Rand. So let's do that one first. 12% convertible preference shares. A convertible share is a share that is going to be converted probably into an ordinary share. So we've issued 50,000 shares at 3 Rand a share. 150,000 12% convertible pref shares is going to be credited with that amount, and bank is going to be debited with that amount. We have incurred share issue costs, so we're going to debit share issue cost 1,500 Rand. We're going to credit bank 1,500 Rand. Come year end, we're going to debit the convertible pref share account. Well, here we can do that immediately, and we're going to credit our convertible pref share account. Share issue costs, we have to maximize retained earnings as far as possible, so therefore we have to, in this case, write it off against the capital account itself and not against retained earnings. Great, sorry, we're not supposed to do that. Now, on 31 December 22, 3 months after the issue took place, so when did the issue take place then? 30 September 22. The directors decided to convert 60% of the shares into ordinary shares. The conversion price per share was 11 Rand and 25 cents. Now, what is important is when shares are converted from one class of share into another class of share, I just move equity around. Obviously, what I have to do is I have to, for this 60% convertible pref shares that I'm going to convert, I'm going to cancel their share certificates, their preference share certificates, and I'm going to issue to them new ordinary share certificates. Now, the question that you want to ask yourself is, how many shares, ordinary shares, do I have to issue in order to give the preference shareholders value for the 60% pref shares that they have converted? And they tell me that I'm going to convert it at 11 Rand 25 per ordinary share. So the first step is first to determine how much capital do we have to move out of the pref share capital into the ordinary share capital. 60% of the 150,000. Remember, the shareholders got absolutely nothing to do with how much costs were incurred by this company in order to make the share issue happen. All they have done is they have invested 150,000 Rand in this company. So now 60% of their investment is going to be converted into ordinary capital. So 60% of the investment of 150,000 equals 90,000. So what do we do with conversion? We move it out of our pref capital into our ordinary declared capital account. So I make this less, I debit convertible pref shares and I credit ordinary shares declared capital 90,000 Rand. So now I have the value of the issue of additional ordinary shares. They tell me that I've issued those shares at 11 Rand 25 per share. There it was, 11 Rand 25 per share. So now I can work out how many ordinary shares were issued in order to make good for this 90,000 Rand that I had converted. So 90,000 divided by 11 Rand 25 tells me that I've issued 8,000 8,000 ordinary shares in exchange for the 60% of that 50,000. So it's 30,000 ordinary shares that was going to be equal, 30,000 preference shares that's going to be equal to 8,000 ordinary shares. Can you see there's quite a difference in the number of shares? Why? Because guys, the ordinary share is worth much more than a preference share. Please go back to your videos on the conversion of shares. Have a look at that video again, and there I also explain why an ordinary share is worth much more than a preference share. Great. Now I'm done with that one. Profit after tax for the year, but before any dividends was taken into account, amounted to 500. The opening balance for retained earnings was 400,800. So 400,800. So I have to put that in my statement of changes in equity. I haven't put that in as my opening balance. And then I have to do a little calculation. What type of calculation do I have to do? Guys, we have to determine first what was the interest that we have to pay on this redeemable shares. Because this 500 was before any dividends were taken into account. Now, although strictly speaking, we treat the cumulative compulsory redeemable pref dividend as interest, in actual terms, it is still a dividend. We handle it, and the receiver of revenue handles it as an interest payment. But on that dividend certificate, on that share certificate, those preference shareholders all have preference share certificates. On that is indicated that there's a 10% dividend attached to that. So that means we first have to determine what was that dividend that we need to pay these shareholders. Remember, we redeemed 50% of these shares halfway through the year. So that means if we want to work out the dividend applicable on redeemable pref shares for the full year, what should we do? We should say, okay, well, on the full outstanding amount, 1650, the opening balance, multiplied by 10% for a 6-month period until the date of redemption. That interest dividend, whatever you want to call it, equals 82,500. Then we redeemed 825,000. So what was the remaining balance? 825,000. So for the second half of the year, the outstanding capital balance was 825,000 multiplied by 10%, multiplied by 6 months. It's time-based, always time-based. So the total dividend is in 123750 on redeemable pref shares. So that 123750 we have to treat as interest. Now they give me the net profit for the year. They tell me here profit after tax for the year was 500,500. Right here they tell me assume a company tax rate of 28% and a dividend withholding tax rate of 20%. That is also the actual rates in place at this point of time. So what do we have to do with the 500? That is a profit after tax. Now, once we have calculated the total interest, which equals the dividend on the redeemable pref share, we first have to convert that to an after-tax figure before we can do anything with that against our profit after tax. It's a profit after tax figure, very important. So what do? we can say, well, the expense is 123,750. The receiver of revenue allows that as a deduction. So what is the expense then in actual terms after the deduction? Only 72%. Remember, tax rate 28%. 100 less 28 equals 72. So 123,750, 72% is going to be the after-tax impact of that expense. So then 89,100 is going to be subtracted from our profit after tax of 500, and that is going to give us a profit after tax of 411,400. If you don't understand that, we can go the long way. We say profit before tax is the first thing that we have to calculate, and you will see a lot of calculations. You have to do more than only one adjustment against profit before tax or profit after tax. Then this first method is the best method to work with. We convert our profit after tax first to a before tax figure. So we say profit after tax equals 72% of the total profit figure. Remember, tax rate is 28%. So it's my profit less 28% of my profit equals my net profit after tax, which will then equal 72% of profit before tax. So therefore, if I take my profit after tax of 500, I divide it by 72%. I work backwards to my profit before tax. Now I have my profit before tax. Now I can deduct my full interest amount of 123,750. Less interest, 123,750. Then I have an adjusted profit before tax figure of 571,389. That less that. Then I recalculate tax, and I say tax is 28% of profit before tax, which equals 159,989. So profit after tax must be my profit before tax less my taxation figure equals 411,400. See, it's the same. Doesn't matter which one of the two I use, I get exactly the same answer. So profit after tax 411,400, and in my statement of changes in equity under retained earnings, profit for the year 411,400. Great. Now we have to determine what is our dividends. An ordinary dividend of 20 cents per share was declared at year end. So what is this? Interim or final? This is final because it's year end. And all shares that were in issue on 31 December 22, where are we now? 28 February, are entitled on the dividend. The dividend was only paid to the shareholders on 31 March. Right. So, when did this conversion took place? This conversion took place on 31 December. So these shares are also entitled on a dividend. So we had initially 600,000 shares to start off with. Then we have issued another 150,000 shares. And then with a conversion, we have worked out that in order to make good for that conversion of 90,000 Rand, we must have issued another 8,000 shares. So how many shares were in issue at the end of the day? 600,000 plus 150,000 plus 8,000. Remember, ordinary dividend is not time-based. Everybody who is entitled on the dividend will receive the full 20 cents per share, which makes up a total of 151,600. Now, we had convertible preference shares, 12% shares. We have issued 150,000 worth of it. When? After the conversion, the issue amounted on 31st, 3 months after that issue. So on 30 September, we had issued that initial 150,000 shares. And then 3 months after, we've done the conversion. So that means then 50,000 times 3 is 150,000 Rand that we've issued, multiplied by 12% for a 3 month period. And that was 4,500. Then the remaining shares. So we've converted 60%, so how much is left? 40% of the 150,000 is left. Or if I want to go back here, 150,000 less 90,000 equals 60,000. Same thing. 150,000 times 40% is 60,000. Times 12% for the period January and February. So therefore 1,200 Rand. So the total convertible pref dividend, 5,700. Ordinary dividend, 151,600. So total dividends for the year is that 5,700 plus 151,600, which equals 157,300. So here in our statement of changes in equity under retained earnings, dividends, 157,300. The C part of the question wants you to journalize only the ordinary dividend. So only the ordinary dividend, dividends, debit, which went initially to eventually to retained earnings, so dividends, and that is part of our transfer to retained earnings. 151,600, 80% will be paid out to the shareholders for dividends. So shareholders for dividends, credit 121,280, which is 80% of that amount, and SARS dividend withholding tax would have been 20% of that amount. What I didn't put in here is the statement indication. Statement of changes in equity, shareholders for dividend, statement of financial position, SARS dividend withholding tax, statement of financial position. Right. So guys, if we're going to ask you something backwards, and I give you the shareholders for dividends outstanding amount, and I've told you that all the shareholders were entitled on a dividend. So I give you the 121,280, and I want you to work backwards to the dividend. Then you can say, okay, 121,280 divided by 80%, and you are back at the dividend. So please don't think upside down or from A to Z. Also start thinking from Z to A, because all these things actually is interlinked with each other.